In today's video, I am going to be breaking down Visa and MasterCard stock, which one's a better buy, and if Visa is better than MasterCard or vice versa. Let's get down, let's check out these two really interesting stocks. So first off, at the time of recording this video, Visa is being traded at $201.37, being up about 1.5% roughly at this point in time. Its dividend is at 0.76%, so it is not exactly a dividend stock when it comes to what we would normally be looking at. We usually look at stuff over 3%. However, its average volume is sky high, and the beta isn't all that bad either. When it comes to the 5-year chart, this is when it really becomes really interesting. As we can see, it's had pretty much a straight line up. If we were to really incorporate a line, that is essentially what it would look like. Then we obviously had a little bit of turmoil here, in which case it actually lined up quite interestingly enough in line right there with its previous level of resistance, which is actually really interesting to me. It's currently dipped recently quite low, and it's currently testing going between its past levels of resistance. So it's actually quite interesting. I think that it could potentially drop to maybe about 180, 190-ish. However, at this point in time, it may be a really good stock to pick up. We have to remember that Visa is the future of payments, in my opinion anyways. So when it comes down to it, at least here in Canada and the United States, what we see is, what would you rather use to pay for something? A credit card or a debit card or cash? Well, cash nobody uses anymore. They are only using credit cards as well as debit cards. And of course, there's Bitcoin that's starting to pop up. Crypto.com has their own versions of credit cards. And what we are seeing when it comes to payments with cards is debit cards are terrible to use when it comes to security versus Visa, MasterCard, Amex. Those companies have a lot more security, because if you were to have your debit card stolen, or if you were to have your debit card basically used for illegal purposes, somebody steals it or something along those lines, you have a very low percentage chance of the bank actually caring and giving your money back. They don't have to. However, when it comes to credit card companies, they have to. They are insured, which means that if I lose my credit card and somebody uses it, it doesn't matter. I'll get that money back. While if I lose my debit card, that's not going to happen. I know a lot of people who have lost their debit cards and had thousands of dollars used from their account, and it was never paid back to them by the banks. Credit cards are a much safer way to interact. When it comes to dividends, they do frequently increase their dividends. They increased them recently in 2019 from 25 cents to 30 cents, and then 30 cents to 32 cents, and then more recently from 32 cents to 37.5 cents. And with more and more transactions being taken online, there's going to be more and more of these credit cards used. We even seen this in 2021 this year, where they are making more revenue and also more earnings than ever before. 2020 was down because people were out of work, but they were still able to withstand that ability, or at least that issue that was going on. They also frequently beat earnings estimates. When we start looking at MasterCard, they are also up today about 1% at the time of making this video, and they have a pretty good average volume. However, their beta is much higher than Visa, so that's better in my opinion. However, the PE ratio is much higher. The PE ratio of Visa was 35, while with MasterCard it's almost 41, which means that technically MasterCard is a more expensive stock than Visa. MasterCard also has a 0.5% dividend, which is much lower than Visa, but either one of these companies, because Visa was at 0.75 roughly, and that is about 50% higher. However, neither of these are paying a dividend that is going to be able to pay us if we're looking to either remove a job from our time, which means like quitting your job, or if you are looking to retire, this is not something that you'll be able to live off of unless you have millions of dollars. However, they do frequently increase their dividends, so if you're looking at it as a 20-year-old, then 30, 40, 50, whatever years down the road, then that's when those dividend increases will start catching up to you. We can see that they also have roughly the same chart. We see these same dips that we see with Visa, and we've also seen a recent pullback as we've seen with Visa as well, however, just not as far. They also do frequently increase their dividends. We've seen here from 33 cents to 40 and 40 to 44 cents. That's a 10% raise, and that's actually fantastic. If you're continuing to get anywhere from a 10 to 20% raise every single year on a dividend, that dividend is going to increase like crazy if you look to hold it over a 10-year period. MasterCard actually has a higher increase on average, at least from what I've seen over the past couple of years. Just over the last 3 years alone, it's up about 19 cents, which means that that's a 76% increase, which means that 0.5% increase or 0.5% dividend this year in 3 years will be 0.88% on your initial investment. And then in 6 years, it will be 1.55% on the original investment that you put in. And then in 9 years, you're looking at 2.72% on your initial investment. And then if we go out to 12 years, you're looking at 4.79% on your initial investment. And if we go to 15 years, you're going to 8.44% on your initial investment. And this is not even including the fact that you are reinvesting potentially your dividends. And then if we go to 30 years down the road, you are now at 142.5% of your initial investment, which means that 30 years down the road, if you were investing $10,000 today, in theory, obviously we have to remember that whatever has happened in the past is not necessarily going to happen into the future. But if this trend does continue, what we are looking at is a dividend of a massive $14,250 if your initial investment was $10,000. And that's not including the fact that the stock itself will appreciate, or if you were to reinvest your dividends. So if you were not to reinvest your dividends in the same stock, and you didn't add any more money to this stock, and you invested $10,000 today and you waited 30 years, in theory, then you would be getting paid around $14,000 a year in dividends. This is why when you buy a dividend style stock, whether it's a high growth or a medium growth stock or not, and it pays a dividend, to hold it long term, because that initial investment will be huge payouts going into the future. And keep in mind, on a $10,000 investment, you would only be getting around $50 of dividends every year because it is such a low dividend. But 30 years, in theory, you'd be getting $14,000. That's the mindset that we have to really think of, especially if you're a younger investor or somebody who's looking to get into investing at a young age. For example, some of the players who I coach have talked to me about investing, and this is, if you're watching this video, this is something that you really have to take into account is, am I willing to hold this stock long term? And if I do, will that stock's dividend increase so that in 10 years, 20 years, 30 years down the road, I can live off my dividends and not have to work a crappy job, or a job that you dislike, I should say. We've also seen increased revenue year over year up until, of course, that pandemic. We don't have the full 2021 numbers as of yet. They're still coming in. However, we can see that they've had still a pretty good 2020. They also do beat earnings estimates out of the last 4 quarters as well. So that's absolutely fantastic. I hope that this video has helped you. If it has, hit that like button and subscribe. And I'll see you guys again next time.